in a moment, I'm going to be introducing Eric Gray. He is with our office and also a CPA, so a certified personal accountant. I see you're on here. How you doing today, Eric?
Hey, how's it going?
Good. Very good. So yeah, Eric is going to be talking to us today about Realtor financials. And I'm not going to take up too much of the time with the intro because I'm sure we got a lot to cover. Yeah, Eric's going to be bringing his expertise on how to structure your business financially, right? We're going to be talking through things like best practices for starting an LLC, an S Corp, what entity should we have this business in? Or are we at a point where we need to keep it just a sole proprietorship? I don't know. Eric does. Let's find out. Talking about taxes, right? Everybody's favorite subject. And I know some of us are probably still burning from last April. So, we're going to get some tricks and tips on how to make that a little easier because that comes around every single year. And yeah, it's going to be a really, really great class. I'm super happy you're all here. And this will be recorded because I'm sure there's going to be a lot that we need to reference later. So when this is all done, if there's anything you want to revisit, talk about again, I'm sure Eric will be open for questions, but you can also reach out to your agent services team and they can get you a recording. All right. So without further ado, everybody, I'd like to introduce Eric Gray.
Cool. Hey, everybody. Very glad to be here. I know that taxes, accounting, this type of stuff can get a little tedious sometimes. So I want to encourage as much participation as possible. If anybody has questions, feel free to reach out. You can either hit the little, raise your hand icon, or frankly, just unmute yourself and say something, or even keep yourself off mute. I don't care. I want to make this interesting for people and helpful. I think that's the most important thing, is that this is helpful for people. I've got a little, PowerPoint thing that I put together mostly just to keep myself on track and make sure that we talk about some of the things that are important. But again, if there's anything that you want to make sure that we talk about, please just let me know and we'll make that happen. Let me get my screen share going here. This is probably I like this picture a lot. It's like probably the coolest slide I've got on here. So just to temper your expectations a little bit. We are talking about taxes here after all. So. But doesn't that look inviting? It looks really nice and peaceful, I think. So I am an accountant. Like Jason said, I am also a realtor. So I speak your language very well, and I can help you all a lot with the things that we'll be talking about today. And so if there's ever any questions that you want to reach out to me for offline, please feel free if there's something specific to your situation. I've been a realtor with Keller Williams for 4 years, 3 years, something like that now. And a part-time realtor, but a full-time accountant. I worked at a couple of big national accounting firms in their real estate department. So working with everything from real estate agents to investors to landlords to partnership syndicates, doing big multifamily deals. So really anything in the real estate space is something that I'm comfortable with. And I've since gone out on my own and I've started a company called Evolution Accounting and Consulting. And here I deal with a lot of people in the real estate space, but I'm not 100% real estate like I used to be, but that's probably my heaviest industry right now is still real estate. So there's a few things that I thought we would talk about today. And again, I'll keep saying this, please raise your hand, please say something if you have questions, but I thought we would talk about, what are the kind of the first steps when we start real estate. I know a lot of people are beyond that, but you'd be surprised. Some of the seasoned veterans that I talked to have not taken all of the quote unquote first steps. And so I want to just mention some of those things. And then talk about some common tax deductions. And this is the area that we can really dive into the weeds on. And so I want to be a little bit careful on how nuanced we get with that part of the discussion. Everybody wants to know about tax deductions. So we'll definitely talk about some of those things. And then as Jason talked about, entity options, what is the best for us? Should we be an S corporation? Should we be an LLC that's not an S corporation? Should we not do anything? And there's some reasons why we want to do certain things and reasons why we might not want to do certain things. And so we'll talk about that a little bit. So the very first thing, one of the most important things that we do when we start a real estate adventure is that we open up a business bank account. And the reason why I say that's so important is because we've got to start looking at ourselves, and I think a lot of you do already, looking at ourselves as business owners. That's truly what we are, whether we lead big teams or if we're a single agent just getting started. The IRS certainly looks at us as business owners, and so we need to do that as well. And having a separate bank account is important for a couple reasons. One, at tax time, it's going to be a lot easier to find your income and your expenses if you only have to look in one bank account. If you're trying to go through your personal and your credit card and everywhere else, it can be difficult to do. But this other reason I think might even be more important is that if you get audited, of course, that's the big A word that nobody likes to hear, but it does happen. It's rare. But if you get audited, the first thing they're going to ask you for, if it's a true audit, is your bank statements. And so you probably don't want them to look through your personal bank records if they don't have to. And so if you can keep the auditor focused on just your business bank account, that's going to potentially stop other cans of worms from popping open. And there's also just some privacy concerns there too. You don't really want to see what all you're buying for Mother's Day or through the holidays or whatever. And so having that business bank account is really easy. You don't even need an LLC to do that. I think you do need to have a tax ID, but you don't need an actual LLC opened up to open up the business account. And then we also want to have some sort of bookkeeping process. And I see a lot of things. I'll tell you that. I do see the shoebox. Like I literally have a shoebox in my office right now full of papers. I thought that was a joke, the shoebox, but it actually happens. And I've got a lot of people that do things on spiral notebooks, but really, if you can use Excel, that's fantastic. And that can help you to organize your expenses and your income. You can start to track how much you're spending on office supplies, marketing, all of those things. But personally, I recommend QuickBooks or something similar. There's some sort of software that will connect to your bank account, and it'll download transactions right from your bank account. And so you don't have to worry about whether you remember to deduct something or not, because it pulls them from your bank account, which is another reason why it's probably important to set up that business account in the first place. And then once you've got QuickBooks set up and it downloads transactions from your bank, all you've got to do is categorize it. Is this rent? Is this office supplies? Is this my Keller Williams dues or whatever it might be? And you can track things, categorize things really easily there. Then we've got to figure out, well, how do we track miles? Because miles are probably one of our biggest expenses. At least they are for a lot of the realtors that I work with. Miles, I think for 2022, I think we're getting something like 58.5 cents per mile. And so if we drive 10,000 miles, that's $5,850 of write-off. And so we want to make darn sure that we've been tracking our miles. We don't want to miss that deduction. It's really big. And there's a couple ways that we can track those miles. You can either do an app. Actually, QuickBooks has an app. You can track your miles that way. There's something else called Mile IQ. I'm sure there's a bunch of apps out there, but the apps are probably the best way, or maybe the easiest way to do it. You can, just have a piece of paper in your car, and you write down when you do something for work. So you can say, okay, on whatever today is, June 7th, I drove down to the Keller Williams office, and I worked there for a little while. And then I left the Keller Williams office and I went to show a house. And you're tracking your miles, you're tracking the date, and the purpose of those trips, and you can start to deduct your mileage expense too. The last step that I have down here is to build a team of professionals, and I know you all know how important that is. A network around you that can help you and your business grow. And so that's probably any number of people, but certainly you want some lenders on your team that you can work with. You might want a sign installation company that you work with. You might want photographers that you can work with. You probably want a good CPA that you can work with, maybe a financial advisor, maybe an insurance provider, but build that team around you, because again, we are now running a business, however small or big that business is. As a realtor, you are running a business, and we need help from time to time. And there's certain things that we've got to delegate. I would never want to represent myself legally, right? And so I'll always make sure to have an attorney on my team. But so those are kind of the first steps. Are there any questions on any of those four things? I think that's kind of the foundation for what we're going to dive into after this. Anybody got any questions or comments? Awesome. Either I am the best explainer ever, or you guys are the smartest people ever. I'm not sure which, but let's go with one of those two, right?
I had a quick question for you, Eric.
Sure.
So as far as the business bank account goes,
Yeah.
outside of it just being sort of, excuse me, like easier to manage when tax season comes, all that stuff, are there any tax, like financial benefits you get with having a separate business bank account versus separate personal account?
There's no additional deductions that are available or additional benefits, but it's easier to identify those deductions and those benefits, I guess. Because again, if I'm using, my personal account and my business account, and at the end of the year, I've got to figure out, well, where are all my meals being deducted, or where did I spend money for all my meals? And I've got to go through all of my personal accounts and, okay, actually I went with my mom to that meal. Does that count? Or I went with Jason on this meal. Does that count? But if they're all in the business account, I know every restaurant purchase is a business deduction in there. I don't have to think about it again. It's all right there. It's all deducted.
Perfect. Thank you.
Yeah. Thanks for the question. So some common tax deductions that are available to us as realtors. The first one, I think this is one that a lot of people are interested in, the meals and entertainment category. And these used to be really the same category. There was a line item on the tax return, meals and entertainment, and you would be able to deduct 50% of those meals and entertainment expenses. And a lot of people still refer to meals as entertainment. They use the words interchangeably, perhaps incorrectly, because nowadays, I think it was with the CARES Act possibly, but some COVID act, they decided to make meals 100% deductible. If you're buying your meal at a restaurant, so if you go to like a gas station and get a sandwich, that's not a 100% meal, but they wanted to revitalize the restaurant industry. And so if you're buying a meal that's business related, you're going with a client, a potential client, a vendor, a member of that team that I told you is important to put together. Really any person that you're talking about business with. It can be strategy, it can be an actual transaction, whatever. If it's a business meal, you're eating at a restaurant, or frankly, you bought it from a restaurant and took it home with you, that's 100% deductible throughout the rest of this year. A lot of people weren't aware of that, but for 2021, it was also 100% deductible. So for the last 2 years, we got a really big benefit on these meals deductions that I think are important to take advantage of. Meals are separate from entertainment. I know we think about, well, we're entertaining people, but the IRS has them separated out. And what entertainment is if you go to maybe a Vikings football game, or you go golfing, or you go bowling or laser tag, or things like that. Those are considered to be entertainment activities, which again are separate from meals. And so entertainment is unfortunately no longer deductible. If you went to a Vikings game, for example, though, your ticket is not deductible, but any food you bought, any alcohol you bought at the Vikings game would be deductible if you're with a client or potential client, whomever. But the cost of the ticket itself would be considered entertainment and is not deductible. So that's one of the, I guess, the downsides of recent tax legislation. They did away with the entertainment expense. I usually have some questions on that, so I want to pause for a second. Any questions on meals and entertainment?
I did. And I put it in the chat. I was wondering if you buy a restaurant gift card for a client's closing gift, is that 100% deductible?
I would say you can either deduct it as a meal, or probably what's most appropriate is as a gift. There are some other limitations on gifts, which we'll dive into in a second. That one's kind of a gray area, and it could go either way. But I think I've seen a lot of people, and I've seen some court cases where the gift cards are considered restaurant meals, and you can deduct it either at 50%, or in this case, this year, it'd be 100%. So I think you've got a little bit of a choice in how to categorize it, but yeah,
Great.
Good question.
Thanks.
I have a question quick, Eric.
Yeah, Dustin.
Is there any difference between marketing it's like a marketing write-off. So even entertainment as marketing rather than as actual entertainment. If that makes any sense.
Yeah, so if you're hosting an event, then it's definitely deductible as marketing. But just because you go to a Vikings game and say I was marketing, the IRS would tell you. And again, I'm not the IRS, and I try to help my clients, do whatever we can to deduct as much as possible. But the IRS would say, just because you went to a Vikings game and said you were marketing, no, we see right through that, and it's still truly an entertainment expense.
Mhm.
But again, if you were hosting an event, like you threw some community, picnic or something like that, that would be 100% deductible.
Okay, cool. Thanks.
Yeah. Business miles. So I mentioned this a little bit earlier. For 2022, where they increased it to 58.5%. I had a client in here just a few minutes ago, and he's like, "Man, they should have made that 70 or not percent, but they should have made that 70 cents a mile just with how expensive gas is these days." But they set the rate. I guess it might have been back in December or maybe November, and so they weren't fully aware of how. Maybe they were, but they didn't take into account the gas price increases quite yet. And so I'm hoping that the 2023 mileage rate will be even higher. As a point of comparison, 2021 it was 56 cents a mile. So they did increase it by 2.5 cents, but I don't think it increased enough, percentage wise, to compensate us for the additional gas costs that we have. But the mileage that we can deduct is supposed to be in lieu of deducting actual expenses at the gas pump, or actual depreciation on our car, or oil changes. So you can either deduct actual vehicle expenses, gas, gas, insurance, the cost of the car, or you can deduct mileage. It's one of the two, right? Mileage or actual. And so this mileage expense is actually a fairly generous deduction. Maybe that's not a word I should use when describing something the IRS is allowing us to do. They're not usually very generous, but if you think about it, again, using that 10,000 miles that we might drive this year, at $5,800 is a decent deduction. 58.5, is a decent deduction. And the alternative would be that we're tracking the actual expenses. So what did we really spend on gas relative to business travel? What did we really spend on insurance? And they're usually comparable. And there's some other, more complex tax reasons why we might choose one or the other. But a lot of people ask about business miles, so I put that in here. And you see at the bottom, the third point, unable to take actual vehicle. So you can either do miles or actual vehicle expenses. And that's an important distinction to make. Other common deductions, so travel. If we're showing a house maybe up in Duluth or something, right? We can, and we have to spend the night up there, and we can definitely deduct the cost of that hotel. We're going up there for business purposes. Or, a great example is the family reunion down in Austin, right? That's clearly a business expense that we can deduct. It starts to get into, well, how much of that trip to Austin was for this conference versus how much of the trip was for personal fun and enjoyment. And so I guess what the IRS would tell you to do is, well, how long were you in Austin? If you were there for a week, but the conference was 2 days, maybe you've got to prorate your deduction a little bit, right? So you're clearly there for the 2-day conference. And so the expenses associated with that, definitely deductible. But then if you stay longer and you're having fun, you're sightseeing, you're there with your family, unless you have a good business purpose for that portion of the trip, the IRS would probably tell you that's not a deductible portion of your trip. But definitely, the cost for getting down there, the hotel stay while you're doing the conference, that's definitely deductible. Home office deduction. This is another big one that we talk a lot about, and it's become even more common since COVID, with a lot of us not working in the office quite as much. If the Keller Williams office was your primary place of doing administrative work, doing the listing agreements, or you had clients coming in, or your paperwork is mostly done at the Keller Williams office, that's your primary place of administrative work, then the IRS would tell you you're not supposed to also deduct the home office expense. So the home office deduction is available for people whose primary place of administrative work is done at the home. And so sure, if you're doing some work at the office, that's totally fine. But if the primary place for your administrative work is at home, then you might be eligible for this home office deduction. And then you've got to find a place in your home that is used regularly and exclusively for work. And so the IRS, I keep saying the IRS would tell you, because again, I'm not the IRS. I'm on your side, I promise. But it's also my job to tell you, what the IRS would say. And so the IRS would tell you, well, just because you're answering emails, on your couch in the living room, and you do that a lot, well, you can't say that the living room is your home office. You've got to have an exclusive area that is a home office. And so if you've got maybe a little den, or you've got an actual office, maybe you've got a spare bedroom that nobody ever uses, and then you can probably say that's your home office. But the kitchen table, the couch, things like that would probably not qualify for the home office deduction. And there's two ways that you can deduct expenses for the home office. And just like they gave us two ways with the vehicle, right? We had the mileage, or we had the actual. We also have two ways for the home office deduction. And the first way is the simplified method. Everybody loves a simplified method. It's really easy to do. And they say $5 per square foot, and per square foot of your office. So if you've got 100 square feet for your home office, then $5 per square foot there, you get a $500 deduction for the year. The indirect method, or the non-simplified method, would be you take the percentage of your home that is the office. So just for easy round numbers, you got a 100 square foot office, you've got a 1,000 square foot home. 10% of your home is for the office, right? 100 for the office, 1,000 for the home. That's 10% of the home. Then you would be able to deduct 10% of the cost of operating your home. That'd be 10% of your utilities, 10% of your internet, potentially 10% of either the rent or the mortgage interest. And so you might get a bigger deduction with the non-simplified method, or this indirect method. Without getting too deep into the weeds here, there is a downside to this non-simplified method. I guess it's a downside. If you're doing that method, you are also allowed to and supposed to depreciate 10% of your home. And so again, using my simple example, 10% of your home is for the office, and super simple example, your home costs $200,000. Well, if we're going to depreciate it, you're supposed to depreciate 10% of that $200,000. And so you've got $20,000 that you can depreciate, right? And that sounds great. Yeah, who doesn't want to start depreciating it, get more expenses on their tax return? But the problem with that, it's great today, right? When you are depreciating it, it's good. You get to get more expenses on your return. But most people that I've talked to either didn't realize this, or their CPA didn't talk to them about this. You're able to depreciate the home because you've called it a business asset, right? We can't depreciate personal things. That's why you can't depreciate the other 90%. You can depreciate that 10%. But now that you've called your home a business asset, when you sell your home, a portion of the home that you're selling is a business asset, right? And just like any business asset that we sell, there might be gain, right? You might have to pay tax on selling that part of the home, on the business asset. And so just want you to know about the entire picture, and not just the potential great part of depreciating. There might be tax to pay when you sell the home in the future. Any questions on that? I know we could talk about that for an hour. There's a lot of nuances there, but any questions on that piece? Cool. Other simple deductions that we've got available to us, right? Clearly we can deduct office supplies, pens, paper, whatever, equipment. If you're doing your own photography, your camera, all those things are deductions. I don't think there's any surprise there. I have a comment about the $2,500 de minimis election, and that just says If you buy something that, you might think of as an asset, right? A lot of people would think of a fancy camera as maybe being an asset that you've got to capitalize and appreciate, and, treat, really fancy tax way. But if it costs less than $2,500, they call that a de minimis purchase, an inconsequential purchase, and you can actually expense that right away. You don't have to actually call it a formal asset and capitalize it and do all that stuff. So anything that's less than $2,500, expense it right away. Obviously, we can deduct our fees and our dues, our marketing expenses. I bet, Chris Lindahl probably has a huge marketing with all those billboards, man, that's a big marketing deduction, right? But it's clearly a tax deduction, and it's generating business, and bus benches, business cards, social media ads, all those things definitely deductible as well. This next category is one that usually spurs some conversation and some debate, I guess. Client gifts, right? And the IRS, I guess it's the Congress law. Congress is one that institutes tax law, and the IRS just enforces it. But the law that Congress put together says that you can deduct $25 in gifts per person per year. And so, a lot of us would give out gifts, closing gifts that cost more than $25 per person per year. And I think there's great reason for doing so, as long as we're mindful of the fact that the law would only allow us to deduct 25. So if we spend 200, probably great reason for that. It's, all about, building client relationships and rapport. And, we just, got a good check. And so we feel like, giving some of it back to them and saying thank you. But the IRS will only allow us to deduct 25. And then we get into the question of, well, what if there's a family of 4 that we sold a house for, right? You got the mom, you got the dad, they've got 2 kids. Does that mean we can deduct $100 for the closing gift? And I'd say, yeah, honestly, I think you can deduct, in that case, $100 for the gift. I think your argument or your case would be strongest if it was something that all 4 people could share. If you've got a 4-year-old kid and a 6-year-old kid, and you gave the mom and dad an expensive bottle of wine, maybe you might have a harder case when you're talking to the IRS on how that gift is to be shared between all 4 people. But theoretically, if you're giving a gift to the family, no matter what it is, I suppose you could probably say a client gift would be, in that case, $100 that you could deduct. Then I often get the question of, well, what if I put my logo right on a gift that I gave somebody? And in that case, well, if you have your logo on something, it's more of a marketing expense, I think, and less of a gift, right? You're giving out swag, and so I think you can get away with a lot more expenses by putting your logo on things. And so keep that in mind. If you have your logo on it, it really is more of a marketing item. And sure, you're giving it away as a gift, but I think you have a stronger case that it's marketing swag and therefore fully deductible and not subject to that $25 limit. Any questions about gifts? I must be killing it. Am I killing it or what? What's going on here? And then we've got,
now question. I'm sorry.
Yeah, go for it.
So what do you have to prove that it's the differential between a marketing gift and an actual client gift, a closing gift? Do you have to prove that your logo's on there, or?
I guess to some extent, and for probably 98% of tax returns that get filed every year, it's kind of on the honor system, honestly, right? And of course, there's ethics that we got to grapple with, and morals and things like that. But 98% of tax returns don't get audited. 2% do, and I think they're trying to increase that number. They're having a hard time with their own staffing issues and whatnot. But if you were to get audited, and that's the only time where you'd have to quote unquote prove something, you don't ever have to prove anything unless you get audited. I always recommend people keep receipts and records and make notes and keep logs and all that type of stuff in case you get audited, but you never have to show anybody unless you get audited. And so if you're one of the unlucky people that do get audited, and they see you've got, a $5,000 expense on your client gifts, they might say, okay, well, tell me about that. And if you can say, well, that was really for, 10, however many people that would be, 1,000 people, $25 a person. That's how I got there, whatever the number comes out to. Or, hopefully you categorize it not as a gift, but as an advertising expense. I've never seen them like ask, well, show me what you gave somebody. Like, show me a picture of the item you gave away. But theoretically, they could tell you to prove anything, and they can tell you to prove anything they want to. They do have that prerogative. But I don't see them asking for proof like that. I've never seen that. But if you really want to have your T's crossed and your I's dotted, I guess you would you would have an invoice of the item that you purchased, right? So if you bought 500 koozies with your logo on it, and then you can just kind of track when you're giving them away. I don't know. I mean, that's kind of a hard question to answer, just because like honestly, you really have to prove anything. But if the IRS were to ask you about it, you would have to show them receipts or somehow make them comfortable, look him or her in the eye and say, this was a marketing expense and this is why I think so. If your logo's on there, that's one way to make it a marketing expense. Does that help at all? Then what else we got here? So subscriptions for professional publications like magazines or anything that you're subscribed to, that you're getting ideas from or you're learning from, education especially. If you're paying administrative assistance, that's obviously deductible. Virtual assistants, transaction coordinators, all of those things are deductible. Commissions paid to team members, or some people pay money for showings. So you're paying somebody 25 or $50 a showing, that's definitely deductible as well. A lot of people forget about that when it comes to tax time. So yeah, if you're one of those people on Facebook on the group to say, hey, I got 25 bucks, someone go show a house for me in Bloomington, make sure that you keep track of that. And when you are preparing your tax return at the end of the year, you have all of these, you might call them a commission, you might call it a fee, whatever you want to call it, that you've paid to the team members here at Keller Williams that have helped you along the way. So that could be the showing assistance. It could be, hey, I need someone to let somebody in right at this house, and now I'll pay you $50. So all that stuff is deductible. Transaction coordinators, they can be lifesavers for a lot of us. That's clearly deductible also. And then of course, professional fees, attorneys, accountants, the cost of preparing your tax return is deductible. If you need an attorney to draft agreements or things like that, or if you use an attorney to put together any of your documents that you have with clients, those are deductible expenses also. Then we start getting into a little bit more kind of self-care deductions, right? Those are all what I like to think of as operating expenses before. Those are required to run the business. But now we've got things that are helping us personally. Retirement contributions. There's two types of retirement accounts, some of which are deductible now, like a traditional IRA or a traditional 401k. When you put money into that, you get to deduct the amount that you put into that account. A Roth IRA or a Roth 401k, you don't get a deduction today, but when you take the money out at retirement, you don't have to pay tax on the money when you take it out. And so, the people are always asking, well, do I want that deduction today and I'll pay tax on it later when I take it out of my account? Or do I want to pay tax on the money now and then, take it out tax free? And of course, I'll always recommend that you talk to your own financial advisor on your specific situation regarding your financial goals and whatnot. But from a tax perspective, typically the longer you keep money in an account, the more it's going to grow, right? And the more advantageous that Roth IRA or that Roth 401k becomes. If you can grow your account a lot and you take it out tax-free in 10 years and 20 years, whatever it might be, that's going to save you a lot of taxes. And so the more you expect that account to grow, the longer you expect it to be in there, the more likely a Roth is the better option for you. And as self-employed people, we have another option available to us, and that's called a SEP. It's actually a self-employed pension, I believe is what it's called. And that's now available to people that are self-employed, and you can put a lot more money into that account than you can into a regular IRA. Regular IRA, it's maybe $7,000. A SEP can be up to $50,000 that you put into it. And so there's a big difference in retirement accounts. Happy to dive into detail with you if you want later, or talk to your financial advisor. A health savings account is another really good option for people. Any money you put into the HSA is deductible this year. And there's a limit for a family. You can put in something like $7,500 for an individual. You can put in about half that. But it's a good way to shelter income from taxes, right? So every dollar you put in there will reduce your taxable income at the end of the year. And then when you take it out for qualified medical expenses, you break your leg, you go to the doctor, you have to get a vaccine, whatever it might be that you're paying for, that's a medical expense, you can take that out tax-free. So you not only get the deduction today when you put it in, but if you're using it for a qualified medical purpose, you take it out tax-free. And then if you take it out for a non-medical purpose, you pay tax on it, and there's a penalty too. So you want to make sure that you are spending it on medical things, unless you keep it in there until retirement. If you keep it in there until retirement age, you don't have to pay the penalty if you withdraw it for non-medical reasons. So some people use an HSA as kind of a supplementary, retirement account in some way. Health insurance is deductible as well. And it's deductible if you are not eligible for your spouse's health insurance through their employer. Or if you're a dual career agent, if you have an employer that offers you health insurance, then you don't get to deduct it on your tax return as a self-employed person. So if you're truly self-employed, you don't have health insurance being offered you from anywhere else, you can deduct health insurance premiums that you pay. But if you are offered coverage from your employer or from their spouse's employer, you can't deduct it. So you got to be careful with that. But health insurance, it's pretty expensive these days, and so that could be a good deduction for a lot of us. One thing that's important to point out is as we are required in a lot of cases to issue 1099s to people that work with us. And so we're supposed to give a 1099 to any non-corporation to which we pay more than $600 for services. And so a couple examples of that might be you've got a freelance photographer that you work with, and you pay them more than $600 per year. You're supposed to give them a 1099 at the end of the year. If you have a transaction coordinator or somebody that's, they're not a corporation, but they're helping you with the transaction side of things. If you pay them more than $600 for services, you're supposed to give them a 1099. If you've got someone that is just running errands for you, your virtual assistant or whatever, and they're not a W-2 employee, and you give them more than $600, you're supposed to give a 1099. And so just wanted to have that quick reminder that we do have that requirement in some cases to give 1099s to people that work for us or that we have helping us throughout the year. All right, entity options. So there's a few different ways that we can be structured from a legal or a tax standpoint when it comes to running our business. And I intentionally said legal or tax. Those are two very different considerations. There might be some legal reasons why you'd want to do something, and there might be some tax reasons why you'd want to do something. And I've got to say, of course, I'm no attorney here, so I recommend you talking to one if you're considering any of these options. But there are two reasons or two categories of thought: the legal category and the tax category. If you just start selling real estate, you don't do anything, you don't create an LLC, you don't create a corporation, you're still considered to be a business in the eyes of the IRS. They still think of you as a business. And the business type that you are is a sole proprietorship. That's the formal entity that you've created by not creating anything. And that's it's just you. You don't have anybody that owns this business with you. It's just you. It's your individual. You would report that on your Schedule C, so it's just part of your normal tax return. You don't have to file a separate tax return. It's just another form on your return. With the sole proprietorship, you are subject to self-employment tax. And so a lot of realtors I work with, they see this number at the end of the year, especially newer agents, and it really scares them because it's 15.3% of your profit. And so if you had, and that's in addition to regular income tax, right? Self-employment tax is in addition to regular. And so if we think of our regular tax brackets, the 22, the 24, the 32% tax bracket, well, on top of that, we've got this self-employment tax, and that's 15.3%. It's not exactly 15.3. I don't want to get into that now, but let's say you had 100,000 of profit, right? In addition to the regular tax you're paying 15,000 of tax on that 100,000 of profit, and so that really adds up quickly. And so there's definitely a point at which it no longer makes sense to just be a sole proprietor and possibly to become an S corporation. And I'll dive into the S corporation here in a second, but that's probably the most common entity structure that I see for most real estate agents is to be an S corporation. If you have a team, maybe there's some other entity structures you might think about, but the S corporation is probably the most common. It definitely is the most common for standalone realtors, or one or two people working together, maybe a husband and wife team. And then we probably all, and I'll dive into the S corp in a second. And then there's probably some quarterly estimated tax payments that you might consider making. And I say you might consider because if you don't make them, there's probably a small penalty, 2 or 3% of the amount that you underpaid, the amount that you didn't pay. But some people would, rather not make those payments, and they know that there's a penalty coming, but they'd rather hold on to that money throughout the year, maybe invest it, right? If you can invest your money at 10%, 8%, and then turn around and pay the government that 2% penalty, well, you did better financially by not making those estimated tax payments. There's another group of people that would say, well, I don't want to make those, I don't want to pay penalties no matter what. So sure, I could make more money by investing it and then paying the penalty, but I don't want that penalty. It just doesn't feel very good. And maybe they think that there's a red flag for having that penalty. I don't think there is, but some people just want to be below the radar at all times, at all costs. And so they'll make those quarterly payments. There's another group of people that would rather make those quarterly payments for cash flow purposes, right? And so if you might owe 20,000 of tax, well, you could pay 20,000 of tax in April, or you could write 4 checks of 5,000 each throughout the year. Those quarterly payments would be 5,000 each. And so sometimes writing a $5,000 check 4 times doesn't hurt as bad as writing a big $20,000 check. And so that's just for cash flow purposes, really, is what that would be for. So some people do it for cash flow reasons, others do it to avoid that penalty, and others don't do it because they'd rather hold on to their money throughout the year. The kind of the first step up in creating an entity, the first entity that most people would create is an LLC. And that's just a super simple limited liability company. And there's some some legal benefits that now come with creating this LLC. It gives you some liability protection. So if anybody wanted to sue your LLC, well, they're not suing you personally. And again, I'm no attorney, so don't take what I say to heart. But I think I know enough about this to at least comment on it. If they sue your LLC, they're not suing you. And so they're only going to go after, quote unquote, what you have in that LLC. And so if you don't have a whole lot in that LLC, well, you've now protected yourself personally from any lawsuits that might be coming to the LLC. If it's just you that owns the LLC, you're still reporting, and I have the acronym SMLLC. It's called a single member LLC. If it's just you, then you're still reporting your income and expenses on your Schedule C, just like if you were a sole proprietor. So the IRS does not think of a single member LLC any differently than a sole proprietorship. It's the exact same. There are no tax benefits whatsoever just by being an LLC, none. You're still, if it's just you, so you're still treated as a sole proprietor. If there are multiple people that own this LLC, you got into business with a couple other agents or whatever it might be, then that business will file a separate tax return. It's now a partnership, most likely. And so you've got to, because you have multiple owners, right? And so you're in partnership with people. And so at that point, the LLC will file a separate tax return. You're still probably going to be paying your quarterly estimated tax payments or not, depending on your personal preference, as we talked about a minute ago. But that's kind of the LLC. There's really no tax benefit just for being the LLC. A lot of people ask me, should I become an LLC? And maybe, but you're not going to save taxes by being the LLC. The next thing is there's the idea of being a corporation. You can actually, what they call elect to have your LLC taxed as a corporation. So you're still technically an LLC for legal purposes, right? I told you earlier, there's legal, there's tax. So for legal purposes, you're still an LLC, but you can elect to have your LLC taxed as a corporation. And you can have it taxed as either an S corporation or a C corporation. I've never seen nor recommended somebody use the C corporation for just pure like real estate activities. If maybe you've got a huge team, you might consider doing the C corporation. There's some nuances there that become beneficial as you get really big. But most people will choose to be the S corporation. I'm sorry, let me take a sip of my coffee. That S corporation is by far the most heavily used entity option that there is for realtors. And the reason is, I mentioned earlier that the 15.3% self-employment tax, right? In that example for a sole proprietor, I said, if you have 100,000 of profit, you're paying not only your regular income tax, you're also paying 15.3% self-employment tax. Well, as an S corporation, you aren't paying self-employment tax. They actually say, well, you're no longer self-employed. You're actually employed by your S corporation. So they look at the corporation as being a separate and distinct entity, and you are now just an employee of that entity, right? And so you're not going to pay the self-employment tax. And so the more money you make, the more self-employment tax you're avoiding. And so the more money you make, the more that S corp becomes attractive. And that S corporation, there's a break-even point at which it becomes, I guess, the better tax answer. If your profit, and I think this is an important piece, and some people might say the most important piece of the discussion for people thinking of S corps, if your profit, again, revenue, commission income minus expenses, if your profit is around 40,000, 50,000, a little bit different for everybody's situation, but if it's around 40 or 50 and above, it probably makes sense to be an S corporation. If your profit's 100,000, no brainer, S corporation. If your profit's 300,000, you should have done that 2 years ago. Get the S corp. And the reason it doesn't make sense from day one or with 10,000 of profit is because there are some costs to being an S corporation. You've got to file a separate tax return. And so, that's, potentially a few $100 up to $1,000, whatever it might be. And you've also got to be on payroll. The employee, the owner, needs to be on payroll. And so if you're paying somebody to run your payroll, that's a cost. If you're doing it yourself, it's just a pain. It's a headache to do. And so you've got to think about how much money am I saving versus how much money am I spending. And you are spending a little bit more to be an S corporation, but you're saving a lot more in taxes. And so again, the break-even point, the point at which it makes sense to be the S corporation is somewhere around 40, maybe 50, definitely 75, without a doubt 100,000. So just keep that in mind, and we can run numbers for you if you want to. But you don't pay self-employment tax on your profit in the S corporation. And so that's why it becomes really important to think about this S corp, because you're not paying that 15.3% self-employment tax on your profit. You do have to get on payroll, and so there is payroll tax, But overall, you're going to save, you know, if you had 100,000 of profit, you're probably going to save 5,000 in taxes. If you have 200,000 in profit, you're probably saving 15,000 in taxes, and then it just keeps going up and up, the more money you make.
Do you lose access to those self-employment, the SCP that you referred to earlier when you go into one of
You
these?
can still use the SCP, the SEP, the self-employed pension. And actually with an S corporation, you can now even, you know, open up a 401k and do some other stuff from a retirement standpoint. So there's a lot of options available to you with the S corporation.
Great, thanks.
I don't think I really need to talk about a C corporation. I would be really surprised if anybody here, you know, cared about that or thought about it. No point in talking much about that. Just a couple closing thoughts here. Record keeping and why it's so important. You know, there's so many people that I work with that scramble after the year's over to get their taxes ready, right? And that's just such a panicked feeling, you know, when your accountant saying, hey, we got to get your stuff in, the deadline's April 15th. And you're like, I don't know where to start. You know, what do I do? And if you are doing record keeping throughout the year, man, it's a breeze, right? If you've got QuickBooks, tax time is so easy. Well, if you're keeping up with your QuickBooks throughout the year, just because you have it, you know, it doesn't save you all that headache. You've got to actually utilize it or hire someone else to utilize it for you. But if you're keeping up with your record keeping throughout the year, tax time is easy. And that's the most obvious reason for record keeping, for bookkeeping, for keeping our financials in order. But, you know, truly as business owners, you know, we are trying to grow our business. And you know, we also, as business owners, need to understand where our money's going. We need to understand where our money's coming from. How profitable are we? How did 2022 compare to 2021? What did we do differently? And so when you're truly doing bookkeeping, when you truly have financial statements, you can see the trends. You can see what's working well, what's not working well. You've got insight into your business that you don't when you've got a pile of receipts in your desk. And so I think as we start to think about ways to become, you know, quote unquote, real business owners and run a quote unquote real business, and there's not a successful, you know, business in the world that doesn't have financial statements being produced annually or quarterly or something. And so we've got to think of ourselves as business owners. And tax time, super easy. Receipt scanners are something you can think about. You can just scan the receipt and it goes directly to your QuickBooks. So then you can throw it away. You don't need to keep it for the 7 years that a lot of people do. If you just scan it in, now you've got it. It's electronic. You don't have to worry about keeping it anywhere else. Just a couple other quick suggestions. Contribute as much as you possibly can to a retirement account. I think that's important not only for tax purposes, but also for your financial security. You know, as we near retirement, it's great to have a good retirement account. We also, this is really important. Set money aside for taxes. And there's a lot of people that when they see their tax bill at the end of the year, they scramble. They don't know how they're going to pay it, and it's because they live so lavishly throughout the year, or not, right? But you've got to make sure that you're setting money aside, because as Jason mentioned earlier, there's something that we know happens every year, and that's tax time. Tax time comes around literally like clockwork. It happens every single year. And so I recommend that people put money aside every transaction that they have. Every time they sell a house, put, you know, some percentage, 25%, 30%, work with your CPA, but find a percentage to put aside into a tax account. It's not sexy. It's not going to grow. It's not invested somewhere, but at least you know you've got money for taxes when that comes. Have that separate business account, work with an experienced CPA, have other good people on your team. And I'll just, you know, leave this slide here. Here's my contact info. If you want to reach out, you know, you can bounce ideas off me. Any questions you have, I'm always here for you. You know, like I said, I'm an agent in the Integrity Lakes office, and been a CPA working in real estate for about a decade, and I think I can help.
Thank you so much.
Thank you.
Thank you, Eric.
Yeah,
That was great. Thanks so much.
you're very
Thank
welcome.
you.
This was great.
Yeah, very
this is
helpful.
really
Thank
good.
you.
Yeah.
Cool. Glad to hear that.
Thank you, Eric.
You're welcome, Jared.